Stocks are pointing to fractional gains at the open. And joining me now with more is Gaurav Mallik, Chief Investment Officer at Pallis Capital. Gaurav, thank you so much for joining. And how should investors be looking to start this week?
There's a slew of data coming in this week. So first, very happy to be on NYSE TV that investors should pay attention to. But I would also suggest to investors that let's wait for the earnings season to come to a full end to get a better sense of what the market is going to look like. There have been quite a lot of surprises in the market this time around. We've seen pretty good earnings growth across the board, but we've also seen leadership move around. Obviously, tech is not as hot as it was last year. Our view is that as far as inflation is concerned, we do see that coming down in line to about 2.3, 2.5 by the time the year ends, and certainly in line with Fed's expectations by the middle of next year. To some extent, I would tell investors as well to ignore some of the noise that's coming. There's too much volatility around each macroeconomic data and release that comes out. But the broad trends are very consistent with our expectations, and that's what investors should focus on. Reasonable growth, consumers still looking good. Inflation in an 18-month window will fall in line with Fed's expectations. There is policy uncertainty, but we'll wait for that to clear up as the year progresses.
We've seen a lot of shakeup certainly happening with this new administration. We know fundamentals does historically drive the market, like the economy and earnings, as you mentioned there. But some of the changes that we've already seen, Gaurav, with this administration, how should investors be reacting to that?
Yeah, so I would remind investors to think back to like the 2016 period where we had a lot of changes occurring, kind of the similar language, perhaps stronger today than it was in 2016 around tariffs and policy and DOGE and all those things. But one of my observations of that 4-year period was that American companies are super dynamic and super flexible. Most companies in that period were able to withstand the impact of tariffs through either changes in their pricing strategy, supply chain reconfiguring. And one of the things I always find very interesting about the US economy and US companies versus any other part of the world is that we're still in a period where we have tight labor markets, but wage growth is still not as high as you would expect in such a tight market with unemployment running at 4%. You're seeing about 3.5%, 3.6% in income growth, a bit better than inflation. But if that tight conditions existed in any other part of the world, you'd expect wage growth to be much stronger than what you're seeing. So corporations have a really nice ability to be flexible, to be able to keep pressures from costs down, to be able to withstand the pressure of these types of policy uncertainties. And I think that's what investors should pay more attention to. Companies really do fantastically in the US, and as you know, operating margins are running at all-time highs right now within the S&P.
Yeah, it's interesting, Gaurav. Of course, amid some of the recent choppiness that we've seen to start 2025, January still ended with gains on the month, and we do see that stocks are still pretty close to record highs, just a few percentage points from them, if that. How does the valuation of the major indexes look at these levels?
Yeah, of course, valuation is challenging, and you've seen that sort of play out most recently and most dominantly in the tech space, which was a space which was the most expensive. So yeah, DeepSeek contributed to it, but I think it's a lot about the fact that there was all these stocks were priced to perfection. I think what investors should pay more attention to is that the valuation still in the equal weighted index, while high, is still not at the same levels. Many of the other markets, whether it's small caps or you look at international markets, which are playing catch up, there you still see some reasonable value. You still see earnings growth that's pretty robust. And I'm very confident, in fact, that with the 175 billion that Google and Alphabet and Amazon were talking about their investments in AI, and the whole sector is looking to invest as much as 500 billion over the next year or two between R&D and CapEx. I think that will have a payoff, and ultimately these companies will bounce back. I do think they're some of the most innovative companies, so I think there will be that bounce back occurring. But in the middle of it, yes, you will see some volatility in that period. Valuation a bit of a concern. I agree with that, but I've also seen that there has been some valuation reset that has occurred in these companies. Maybe a little bit more to go down before investors should consider being strong buyers in these companies.
Do you think the broadening of the market gains that we've seen, Gaurav, beyond just the Mag 7, which we know really led a lot of the gains for the first 2 years of this bull market, can sustain?
I think it can sustain because what we are seeing, again, if you start looking at analyst forecasts for 2024, 2025 earnings. 2024 earnings were all about Max 7. 2025 earnings forecasts do rely on financials, industrials, materials, many of these companies contributing a lot more to S&P's earnings growth as you look at this year. Layer onto the fact that we are still, I feel pretty strongly that the Trump administration, Republicans are going to do more and more to support the industrial base. There is a lot of lagged effect to come from the Biden administration's industrial policy, reindustrialization policy around semis, around the Inflation Reduction Act, which will have payoffs over this period. So I do think that the rally in some of these non-tech companies, non-tech names, can continue for some more period of time. Again, earnings will tell us whether these companies have the ability to deliver on the earnings growth that's priced in. But it's more and more looking balanced in terms of where the earnings growth for the whole index is going to come off between tech, Max 7, and non-Max 7 companies, which is encouraging.
So when it comes to earnings, Gaurav, certainly we've made it through some of the biggest technology companies out there the past 2 weeks or so. What earnings are you focused on this week?
I think that we do want to see what occurs with the remaining companies in the tech sector. We do want to see what's going to occur with the broader industrial materials earnings that are going to come out later on this week. I think that's where we'll be paying attention to. We hate to comment on individual companies, but generally speaking, those would be the areas we'd continue looking forward to and seeing how it broadens out as we look at earnings occurring both the small cap segments of the market and also as we look outside of international markets as to what is occurring on those areas too.
Gaurav, Mallik, thank you so much for joining, especially to break down the markets this morning. Gaurav is the Chief Investment Officer at Pallis Capital.